is Shayna Sissel, founder and chief executive officer of Banyeron Capital Management. Shayna, welcome to the show.
Well, thank you for having me.
Shayna, Fed rates are likely going to be the primary focus of Fed Chair Powell's speech this morning. What are you going to be listening most closely for?
I'm going to be listening for, how hawkish or dovish his rhetoric is. He's been rather hawkish, and the market continues to price in rate cuts that don't happen. And I think there's a little bit of wishful thinking here. You want to listen for him to talk about weakness in specific economic data points. So you want to pay attention to the choice of words. And I know that sounds crazy, but this is how the Fed Watch works. The choice of words when he talks about employment numbers and things like, overall economic indicators, because small changes in the word choice are indicative of the way that he and the policy committee is leaning.
When you say choice of words, what do you think, may indicate that a rate cut might be coming? What type of language?
So he has continued to use the word stability when he talks about employment. Like employment markets are stable. Overall, the U.S. economic conditions are stable. What you want to look at is the change to the word stable. So, if he says strength, that is a hawkish word. If he says that we're starting to see signs of softness, he probably won't say weakness, but softness, that would suggest that he's become more dovish, and that might be indicative of leaning towards a rate cut.
So according to the latest data, investors are pricing in a 70% of a rate cut next month. It was 85% last week. What's changed?
The economic data continues to be fairly stable. And again, the Fed and Chairman Powell have used the word stability a lot. They've always discussed the fact that their mandate is to maintain economic stability. And as long as that's the case, they are not likely to cut rates. And in recent comments, he's continued to use that language. And so as we hear it more and more, every time he's done that, they haven't cut. And so it really does indicate that the Fed is looking for a real sense that there is some instability or some weakness in the economy that is imminent to cut rates. But I think they'll be unlikely to do that and hesitant to do that in that if the economy is doing just fine, in all the uncertainty and the volatility and the tariff threats and this and that, then there's really not a reason to cut rates. You cut rates when you need to ignite economic activity, and there hasn't been a need to do that. And as long as that's the case, the Fed is less likely to cut rates, and that has been the case. So that's why I think as we get closer to September and we're not seeing economic instability, and we're seeing that the tariff uncertainty seems to be less and less of an issue, it becomes less and less likely that the Fed will cut rates, especially as we get closer to the September date.
And if rates are cut, what impact could that have on investors?
Well, obviously, the initial response to a rate cut will likely be positive. It generally means that it's cheaper to access capital. It's cheaper to buy things as a consumer. Your interest rates go down. It becomes a little bit easier to access capital in that respect. So it will likely kind of reignite economic growth in the economy and the global economy, and that's positive for equities. So you would likely see equities kind of take off from there, and obviously risk assets would be positive in that environment as well.
Meanwhile, Shayna, earnings season is wrapping up. What are your biggest takeaways from the numbers and guidance that companies are providing?
So the biggest takeaway is that the tariff policy has had very little impact on corporate earnings. In fact, they've come in so much stronger than expected because they had put such limited guidance into the market from the previous quarter, suggesting that they expected to have an impact from tariffs that would be substantial, but we haven't seen it. And so I think what that tells us going forward is we now have enough data points here to suggest that the tariff policy is going to be paused and continue to be put on hold until people come to the table. There isn't actually going to be an implementation of these really aggressive tariffs. I don't think the administration wants that. And so in the guidance we're now seeing, you're seeing that reflected in the comments from senior executives at corporations that are publicly traded, that they are now less and less concerned about tariff policy, which now recalculates the earnings potential and the earnings trajectory of a lot of companies, especially in the technology space, which is one of the areas that's been kind of a hot button area for tariff threats.
And what advice are you giving to your clients on how to navigate all of the latest economic uncertainties?
Well, Bonrian is a alternative investment focused firm. So we spend a lot of time talking about how to tactically use alternative investment strategies as a way to manage volatility. So we continue to see favorable conditions for things like managed futures, for things like hedged equity, because we have a lot of headline risk, and that type of headline risk can lead to some big swings in your portfolio in things like hedged equity, things like managed futures, things like global macro, things of that nature, whether it be through an ETF product or through a private placement, do a really good job of kind of mitigating volatility in client portfolios. So that's been our primary focus.
All right, thank you, Shayna Sissel, founder and chief executive officer of Bonrian Capital Management.
Thank you for having me.
Coming up, a new study